So, Dan, have you missed this run that we've seen? S&P 500 up for the quarter 6%, NASDAQ comp up 16%. Have you been too bearish?
No, because you may not have heard the answer to the prior question, Sarah, but I said on March 10th, you can look at the tweet, we're covering our shorts for a short-term bounce. And on the 14th, I said with Mike, we think he can get up to 4,100.
Right.
We're getting close. So we've done very well with this bounce. We've gone from 55% net short before the banking crisis to 5% net short on that following Monday on the 13th. And so we've gotten a good portion of this rally. We're up for the year. We're up last year. We're doing very well. Now we're just looking to add back those shorts. And we've started adding a few. We're back up to about 25% of the portfolio being short, but it's nowhere near the 55 we had going into this. So we feel pretty good.
So that was the part about you thinking the regulators would step in, as they did. So got that right. And so now, Dan, when it comes to adding to the short position and being worried about bank earnings and the risks out there in the system, what are you targeting? Are you targeting the banks? Are you targeting the big tech companies, which have kind of been going in the opposite direction?
Yeah, no, we like a lot of the big tech companies. Obviously, Meta's a name we've liked for a while. We were recommending Intel when people hated it. Obviously, the stock's now up over 20% for the year. So I think you have to go sector by sector. So we're targeting the banks. That's where we've started adding back a majority of our shorts. We've gone from having no shorts in the banking system in, I think it was like that following Monday on the 13th, to now we've added back a whole bunch of those shorts because earnings are going to matter and people are going to start to preview those. And the bank stocks haven't necessarily discounted the earnings cuts that are potentially coming. We like semiconductors because, we've hated that space for about a year. Some of these companies, Micron guided to negative gross margins for their upcoming quarter when they reported. The stock was still up 7% a couple of days ago. And so with that space, you've got revenues in some cases that are down over 50% year over year. And so Intel, NVIDIA, those are two names we've mentioned before. We like Facebook a lot. Some of the sports betting stuff we like as well, names like DraftKings or FanDuel. And so they're sectors we like, but you have to remember, we've lived through this kind of sort of false rally narrative back in 08, 09, where the S&P rallied 24% in 6 weeks up until January 6th of 09. And everybody's like, oh, the TARP came in at $700 billion. Everything's good. The worst is behind us. And January 6th is right before the start of earnings season for Q4. Companies reported, guided, and over the next 2 months, the S&P went down 28%. So earnings do matter. They don't matter in the short term. That's all sentiment that matters. But we're going to have earnings in 2 weeks, and I think you need to pay attention to that because a lot of these big tech companies, IT spending in general, financial services is the second biggest spender in that $4.4 trillion. They're about 11 to 12%. These banks are not focused on spending money. They're focused on surviving. And so I think a lot of these tech companies and enterprise, you could have an issue with earnings for them as well.
Well, that would be interesting. That's actually going to be a very interesting part of the bank earnings rush because I was just a few quarters ago, Dan, we were talking about expenses getting out of control at the largest banks.
Absolutely. And so now we've kind of switched to the opposite. And Facebook is a good example of how fast things can change. If you remember, we were on Tech Check back in, I think, November of last year, and Meta had guided to this horrific expense growth. And we were like, well, we like the stock. We're buying it here because they can cut that expenses anytime they want. And then you've had 3 expense cuts since then. Stocks doubled. Everybody hated it at 90. They love it at 200. You look at the banks, you're sort of in a similar situation, as you pointed out, Carl, where, they've gone from, oh, business looks great, and you've got margins that are expanding, et cetera, to now, oh, my God, I got to worry, can I survive? And so they're going to cut back on all the expenses that they can, and that's going to start flowing through to the companies that supply them. And, they're the second biggest spender besides the tech companies themselves on technology. So there's going to be a lot of very interesting cross currents when these companies report because, I gave you Micron on the positive side, but you can also look at Semtech in the semiconductor space yesterday, and the stock was down over 20% when they cut their numbers. So it's going to be very company by company specific, I think, as you go through this.